Really, but I guess I will.
Hi, designers and friends. My name is Marissa McKinney. This is
Emily.
Hi. We're the co-founders of Logistics for Design. For those of you that know us, you know that we're dorky accountants who sit behind our computers all day. So we strive to keep up with the needs of our designers. We do our best to be proactive about what our designers need to succeed. And one thing we've noticed lately is that many of our designers want to dive deeper into their financial statements, but may not have the necessary tools to do so. As is such, we wanted to start this webinar series to help all of you take control of your business with a more deliberate intention and focus. I hope that what we cover here today will leave you with a greater understanding of what those numbers mean on the quarterly reports we send. And I hope that the tools provided here today will help steer your business in the right direction so that you can grow with deliberate focus, intention, and be a rock star in interior design. So without further ado, let's dive in. I prepped a handy dandy little PowerPoint presentation for all of you. So bear with me here as I get that loaded up.
Do we want to maybe wait a few minutes for some people that are running late? Or what do you think?
Sure.
Yeah, is that okay?
Yeah. All right, we're gonna wait about 2 minutes. If anybody has any questions that they want to throw in the chat right now, go for it. But we have a few that have registered that are not quite here yet, so we'll just wait. Emily's got the stats. She's always so on it. I'm gonna go ahead and get started, actually.
Yeah, okay,
Yeah.
sure.
And then
We have a good amount of people, so go for it.
Yeah. Okay. So just to cover some basic terms, they may be basic to some, they may be foreign to others. No matter where you are, you can learn this. It's really good to learn this stuff early, especially if you're a newer designer just starting off. If you can master this terminology before you really kick it off the ground, then you'll be really ahead of the game. So gross sales. Gross sales are basically all of your sales. It's the total number included in the top portion of your profit and loss. And it includes basically all the funds you've collected from your client, excluding sales tax. That wouldn't show up on your profit and loss that we send you in your quarterly reports. Sometimes designers get a little bit confused when they see the gross sales on the Ivy dashboard versus our profit and loss gross sales. Just know that on the Ivy dashboard, your gross sales does include sales tax. It just basically, gives you the number of all of the money that you've received. Once you receive your P&L, if the number looks a little bit different for your gross sales, it's simply because, or more than likely, it's because sales tax was not included in your financial reports that we send you in the quarter. So gross profit. Gross profit is basically your raw profit before you factor in any operating expenses. So it's your total gross sales minus your cost of goods sold. And then your net profit. Your net profit is your total gross sales minus your cost of goods sold minus your operating expenses. It's that bottom line. It's the money you get to take home at the end of the day, or if you're a good business person, putting some of it back into the business. And then we go a little bit further when we factor in net profits, and we break it out actually into two categories. So we like to set up a net operating profit section and then a net profit. So the net operating profits is usually just your net profit before taxes. And we do that because sometimes it's beneficial for managerial purposes to see that net operating profit to make better business decisions, where you're not factoring in taxes that you've paid for corporate income taxes. And then it also allows you to assess your sale or your tax liability, your income tax liability for the years without factoring in the taxes you paid, which your income taxes are generally not deductible. So we like to separate those two out. And don't worry, we're going to show you a P&L example right after these basic terms are up here, and we go over them, and then you'll be able to see exactly what I'm talking about in a little bit more of a visual sense. Okay, a profit margin, and I really want you guys to like look at this definition, understand this definition, because we're going to be talking a lot about profit margins today. And basically, a profit margin is a percentage measurement of a profit that expresses the amount a company earns per dollar of sales, right? So a margin is based upon your per dollar of sales, and it's a percentage, and that's why it's different than just looking at your bottom line net profits. So we want to look at profit margins and percentages, because that will help us to make better analysis of the P&L that we're receiving and analyzing, and it will help us make better business decisions for growth purposes. So your gross profit margin is a measure of profitability that shows the percentage of revenue that exceeds the cost of goods sold. So gross profit margin factors in cost of goods sold. It is used to illustrate excuse me, how successful a company's management team is in generating the revenue from the costs involved in producing those goods or services. In short, the higher the number for your gross profit margin, the more efficient a company's management team is in generating profit for, again, there's that term, every dollar of sale. So you're looking at all the sales and you're trying to determine how good you are at making money off of that dollar. And that's what the gross profit margin percentage is going to help you to do. The net profit margin is the ratio of net profits to revenues for a company or business. It's expressed as a percentage, and net profit margins show you how much of each dollar collected by the company as revenue translates into profit. So a net profit margin factors in your operating expenses. The gross profit margin doesn't. So again, we're talking about net, we're talking about gross, we're talking about bottom lines, and we're talking about percentages. So again, you guys will see these examples. If this is a little bit wordy or it's not really making sense visually right now, then you will see an example here just in a minute. Another question we get a lot from designers is, what's the difference between markup versus margin? So markup versus margin. The difference between margin and markup is that margin is the sales minus the cost of goods sold, right? So it's that gross profit margin we were just talking about, where they're factoring in the cost of goods sold. And the markup is the total amount by which the cost of a product is increased in order to derive the selling price. So it's very wordy when I say it like that, but I think you guys all know what markup is, because when you're creating those proposals and those invoices, you have to put in the markup, and it's very clear to you what that markup is. And that shouldn't be a question of, what is markup. We can get into what industry average is for markup if you guys are all curious about that, because I don't know if they teach you that in interior design school or not, but we definitely have our opinions on what industry average is, and we get to see hundreds of people's financial reports. So we come up with our own numbers for different averages and things like that. And we kind of derive our own industry standards based on all the stuff we're seeing as well, whether people are coming to us new, whether they're just coming to us on a consulting basis. We're able to access a lot of that data, which is really cool, because you do see these trends, and you kind of see what works and doesn't work. So, okay, here is the P&L. All right, so you guys have all seen this. If you are one of our clients. And we structure our P&Ls that we send you in a very specific way and very deliberate way. And while some people are coming to us from different places, they may see this and think, well, why is this necessary? Why do you do it this way? Well, we do it this way for a whole bunch of reasons. One of which is so that you can easily derive the percentages we were just talking about, those profit margins, based on some of these numbers. Another purpose that we set it up this way is for taxes. So these reports to us allow us to easily extract information because of the fact that they're set up this way with these specific accounts. So you can pull stuff out, put stuff in without a whole lot of manual adjustments or corrections. It's the easiest, quickest way to make business decisions with the way that I think we structure our P&Ls. So we went over the basic terms. Now let's see where those show up on these reports. So if you look at this number right here, gross sales, there are a bunch of interchangeable words for gross sales, gross receipts, sales revenue, income, total income, total sales. Don't get confused when people are talking about these different terms. They all mean the same thing. Anything gross sales, gross receipts, gross revenue, they're all referring to this one top line. It's basically all the income you received without factoring in any costs. It's the check your client writes to you that you deposit into the bank, basically minus the sales tax. We don't factor in sales tax into the total income on our profit and loss report. The next term we were just discussing is net operating income. And this is basically most likely the only other expenses you'll see down below are taxes or other maybe like interest earned or things like that. But your net operating income is basically your income before taxes. And we like to separate this number out because, again, I think it's really useful to have that particular number just showing up like that when you're trying to assess your sales tax, or I'm sorry, keep saying sales tax, your income tax liability, or just trying to make better business decisions. Like, what am I making before taxes? Here it is. It's right there. And then you have your net income, which does factor in taxes. And that's just your bottom line. That's your take home. That's what you get to play with, so to speak. Okay, and then your gross profit. Your gross profit is your total income, 235,790, minus your total cost of goods sold, 146,200 in this example. That's your gross profit. Okay, advertising. I'm just going to walk you guys through this entire report. So we went over total income. We went over total cost of goods sold. Now we're going to jump into some of the general operating expenses, and I'll address some of the questions that we frequently get from our designers about just some of these general categories. A big question that designers have been asking us lately is, what's usual advertising budget? What are designers spending on marketing? While I don't have an exact answer for that, because I think every business is so different, some people want a more just a lifestyle firm, and they're okay with just getting their referrals and making a little bit of money and having a side gig. Other people want to spend all of their money on marketing and advertising because they want to be a big firm, and they feel like, excuse me, they feel like this is the step that they need to take in order to get to that next level. So in terms of like average or standards, it really just depends on the business. I can give you some statistics that I've read. I can give you some resources for different ideas if you don't have them. For example, the U.S. Small Business Administration recommends spending 7 to 8% of your gross revenues for marketing and advertising if you're doing less than $5 million a year in sales. So that's one figure. They also say something about the profit margin, right? Here, that same phrase again, profit margin. If you want to go off of their recommendation, you just want to make sure that your profit margin is between 10 and 12% If it's not between 10 and 12%, that means that part of your budget's being eaten up somewhere else, and you probably want to be careful not to spend 7 to 8% because something else is costing you more in your business. So just be mindful of that. You know, if you're going to really go off of that recommendation, I've heard a lot of people say, oh, well, can't you just use like, 5 to 10%? Yes, you can, but just make sure that your profit margin percentage is within a healthy range if you want to use those figures. And then another one that I've heard is just like a flat rate marketing budget. So some people, instead of doing any percentages, they'll just say, okay, I'm going to allocate $15,000 to our design budget this year. I'm sorry, our advertising marketing budget this year. And I'm going to do, X amount on social media, X amount on this. So again, if any of you want, I specifically request this information. Ask your bookkeeper. I'll send you guys a list of links or tools or whatever you need just to give you some ideas. Like, well, I think I want to do a flat rate marketing budget, or I think I want to do this, and we'll send you some ideas. There's also even way more complicated calculations that you can try and use based on the percentages. We'll teach you how to derive today, but that's a whole nother webinar. Okay, so the next one, contractor as an expense or contractor as a cost. So this is a question we get a lot. Where does the contractor payment appear on your P&L, and why does it appear in what looks like two different places? So you'll see up here in the cost of goods sold, you have cost of sales, IV service costs, $15,750. And then down below, you'll have contractor payments at $5,000. Well, the simple answer is it just depends on how you record it. If you're recording a cost of sale in IV as a design service cost, for example, if you're just billing the client for drafting or something like that, then the IV service cost, and you're creating a purchase order, it's going to map over to your QuickBooks profit and loss report in the IV service cost section. Whereas if you're just writing a check and your account manager is just reconciling the check that you wrote to a design assistant as a general check, it's more than likely going to show up down below in the contractor section. If you want, for managerial purposes, for your logistics account manager to reassign or reallocate some of these into one account, we can easily do that for you. There's no right or wrong way of doing this, I don't think, in my opinion. For tax purposes, sometimes it's better to have a higher cost of sale so that your gross profit is less for tax purposes, but for managerial purposes, it might not make as much sense. So it's really how you want to structure it in a managerial versus tax standpoint. But if it's appearing in two different places, that's the reason. If you don't like it appearing in two different places, you can simply request that it get changed and that the funds get moved from one account to another. But most people don't have a problem with it being in two places or having it laid out this way. Or maybe, perhaps, because those drafting costs, and this is for more managerial purposes, those drafting costs are client specific, right? I'm drafting for particular projects. So those are direct costs related to the project versus maybe a contractor who you have, who's, doing basically install help or something like that for various jobs. Then maybe it's a more general expense that you may not want to put directly above there. I don't have any right or wrong answer for how you want to do this. Again, it just really depends on how you want the information received or displayed.
Yeah. Can I add to that?
Yeah, of course.
Yeah, usually that's exactly what we do advise our designers. I know a lot of time, like, you'll be paying with a check for your contractor payments, maybe in like the memo line, putting the project name, and then that way we would know to book it to that specific project.
Yeah.
So that's typically what we tend to do. If it is for a specific project, we'll try to book it in your cost of goods. If it's more of a business expense, then we'll put it with contractors.
Yeah.
Or a lot of people also have this category titled as like outside services.
Yeah, contractors and outside services
is
another interchangeable. Yeah.
Trying to think what else. Yeah. Okay. Sorry, go ahead.
No, that's great. Thank you. Yeah. Okay. Well, I'm glad I put it on there since it sounds like
that comes up a lot. So that's a great. Thank you.
Yeah, I just remember from back in the day. Okay. Office supplies and software. I just wanted to briefly tell you about this in case you haven't been alerted to the fact. I mean, we're halfway through the year, so hopefully you have. But the new tax law states that you can write off almost all of your office expenses. While there used to be a threshold ceiling for the amount that you could write off in a particular year before you had to depreciate it, with the new tax law, you can pretty much write off everything. So you buy $5,000 worth of computer stuff, you can write it all off without depreciating it. So for almost all office expenses this year, it's great because now you can just write off pretty much everything on that. So use that. Leverage that new tax law and make sure you're writing off as much as possible and reduce that income tax liability at the end.
On that point too, we have been categorizing a lot of office expenses like furniture, computers, stuff like that into the office expense category, but we're still kind of feeling a little bit of a few CPAs that still are so accustomed to see it on the balance sheet that they ask us to move it over. So I think that's typically we'll put it under office expense, but sometimes we might get direction from your CPA to move it back. So just keep that in mind.
Yeah.
It might be.
But I mean,
yeah. I guess it depends.
Yeah, then you're getting into it depends. If we get the request from the CPA to move it over, I hope that they have a greater purpose for it, such as maximizing your deductions in a future year because this year you're not making enough money or something like that. Like you want to defer your expenses to another year. I can't imagine why a CPA would advise not doing that unless you had intentions of really not making that much money in the current year and you want to match those deductions in a future year to offset any future revenues received. Most of the time, I would say 95% of the time in these in the newer firms, you know, maybe making like 5 million gross revenue or below, I would say for the most part, you'd want to maximize all of your deductions in the current year.
Yeah, that seems good. Yeah. Okay.
Okay, what else? All right, here are those percentages. So we are able to look at that real world, well, kind of real world, real world example of net profit margin in action. So your net profit margin is basically your, well, for this one, we're going to do net operating income. 65,190 divided by your total income. So again, you're trying to decide how your money's working for you. And then if you wanted to look at your net profit margin after taxes, so not your net operating income profit margin, then you would just take that very, very bottom line, 45,190, divided by your total income, 235,790. And both of these are really healthy percentages. So no matter what, even if you did it after taxes, you're still getting a really healthy percentage. 20% is considered a really good, healthy bottom line profit margin. 5%, you could use a good amount of work. 10% is pretty standard. I'd say like between 10 and 15% is where a lot of people are. If you're at 20%, good job. Keep up the good work. That's great. But, you know, again, this is like a health meter. These percentages are like a health meter for your business. If you're able to look at these percentages and be like, okay, boom, it's 20%. Like, I know I'm doing well. I know my company is healthy. Then good for you. Good for you for analyzing and taking the time to really look at your business and digest these numbers and consider the future. Gross profit margin. So in this example, we're talking about a 38% gross profit margin, which is, again, really good. This is very healthy.
You're making a lot of money. Yeah.
I mean, your net income is 45,000, which hopefully I'd probably aspire to be making more. But percentages are really good. So if you can continue on this trend and continue to grow your business, then you're already on a good trend with the percentages. Gross profit margin 38%. You take the total cost of goods sold minus the total income divided by the total income, and that gives you your gross profit margin. Spoiler alert, we can send you the link to these like really simple calculators, so you can just plug and play basically if you want, where you don't have to even remember these formulas. All you need to do is Google gross profit margin calculator and then they'll give you a lot of these percentages, or profit margin calculator or whatever. So you don't have to like take a math test and remember your percentages. Or if you're like me, I'd write the cheat sheet on the back of my calculator like for the formulas. Well, on the instructors that would allow a cheat sheet, I put it on the back of my calculator and I'd write it up. Okay. The gross profit margin percentage tells us that a company has 38% of its revenues, in this example, 38%, left over after it pays the direct costs associated with making, I did not mean to put shoes, with its sales. So basically, you're looking at the percentage profit based on your cost of goods sold. So you're factoring in those cost of goods sold. And that's really important. If you wanted to take it an extra step, which I really like, and I think you even do this when you send out your financial statements, is I sometimes exclude the service income and service costs, or you could just take the IV sales and the IV purchases. So you're just are you doing that for this too, for the gross profit margin?
No, we're not. We're doing the total
just
ones.
the markups. Yeah. Okay.
Just the markup. Yeah.
So yeah, I mean, it's up to you, but these numbers are all split out, so you can see how you want to work those percentages and analyze them. Okay, what's my gross profit margin, not factoring in services or something like that. So again, 38% is pretty good. Our dear friend Peter Lang from the Designer CPA says he knows a lot of his clients are trying to be around 35 to 40% gross profit margin. I'm finding that it's the more average seems to be about 30%, and then 35 to 40 is really good. And I think that if people are striving for that, that's great. But if you find yourself at 30, I think that's pretty normal.
Yeah, the other thing we see a lot is like your sales, like your net sales might be increasing, but also keep in mind that as your sales are increasing, it's costing more to run your business. So that also increases. So then your net income might not be as high as you anticipated it to be, even though you're doing more business. Yeah. So we see that a lot.
Yeah. And that's just, I mean, again, this is, if you really want to like grow your business, these are the percentages you want to watch. If you want to be a lifestyle firm, you probably just want to increase that bottom line regardless of any of this analysis. But if you want to really intentionally grow your business to be a very successful business that's going to be around for a long time, I think analyzing these percentages is really critical.
That's a good point.
Markup. Okay, so if you're trying to calculate markup from the P&L, you would see in this particular example, it's 61%. This means you sold items for 61% more than you paid for it. Now, again, in my example I'm putting here, we're talking about markup with services included. So you could always pull out those service costs and those service incomes and calculate your markup, or you could just do it, and this is where I think you do it in the reports. You could just do it based on IV sales and IV purchases. And this number I think is good to just kind of spot check on a quarterly basis. So when you get your quarterly reports, spot check this number, and it should be what you use for your general markup terms. So, I mean, everybody does things different. Like some people have different markup percentages for different contracts and different clients. And they may not use the same markup percentage for all clients all across the board. Maybe one client I mark up 15%, maybe another client I mark up 30%. But if you use one markup percentage for all your clients, then hopefully you'll be able to just kind of spot check that percentage with this report and calculate your markup just to make sure that you're on point and you're not missing anything, right? So say I don't know anybody that marks up their stuff 60%.
Yeah.
Industry standards usually about 25 to 35, right? So say you're marking up all of your stuff 35%. You should be able to look at your profit and loss and calculate your markup, and it should be 35%. And if it's less, then you need to like maybe look at where you're losing money. Why am I not meeting my general markup terms when I look at my report as a whole? And it just may require some further analysis. Or you find that it's higher and you're like, okay, score, I must have gotten additional discounts from vendors and it's increased my my markup percentage overall, which is awesome. So just something to look at on this report, another calculation that you want to do for like a health check. And I think that's it. So thank you all for listening and taking an interest in making your business stronger and better and learning more about what those reports mean that we send you every quarter and not just filing them away for a someday read. And also, Emily and I are launching our new website, Logistics for Designers. Check it out. We'll have blog updates and we'll be doing more webinars in the future. We're just kind of going off of trends of what we think our designers want to learn about or want to hear about, or whatever it is that will aid them in their deliberate growth and intentional growth of their practice and their business. And we want to help you guys with that all along the way. So thanks for hanging out, listening, and we'll talk to you soon.
Yeah, sounds good.
Signing up.
Bye.
All right. Oh, any questions? Actually, we could do a little question round if we have.
Yeah, we did get another question about rent. What you typically, what should you be spending on rent? And I actually have the answer to that question here. So I know how when you were talking about how much to spend on your marketing, how much should we be spending on rent? So while it really depends on what type of market you're in, are you in, okay, let me just read this. So there's no set percentage of revenue going towards your rent expense. Currently, we would look at your financials and we would see how much you're spending. So typically we see about 5 to 10% is what designers are spending. But based on the fact if like you're in a more expensive market, if you want more office space, if you're meeting with clients in your office and you need a little bit of separation between people working and people working and meeting with clients, you might need to spend more on your office space. So then again, maybe those percentages could range more up to 20%. So basically it's just sitting down, determining for your business, what's most important. Do I need that larger space for clients visiting? Am I hiring more people? Do we need more room? So it really could be anywhere to 2 to 20% of your revenue towards your rent.
Yeah, I think it's
so
very company specific. And that's why I didn't put anything on there as a standard. Yeah, it's difficult.
It's hard to
based
tell.
on their needs.
Exactly. Yeah.
And it's difficult to say, like, we live in California, so everything's expensive.
Yeah.
So our rent budget's a little bit higher than maybe some other places.
Exactly. Yeah.
State, so.
Any other questions?
You don't know? No? Is that it? Is
No.
that okay? All right.
Thank you, everyone. Feel free to email us with any other questions.
If you guys want any resources sent to you from this webinar, let us know. Did we? Okay. Yeah. Oh, there's just a few. Here's some resource credits. Interior design industry for 2019, I think it is. Link for gross profit margin calculator or net profit margin calculator. If you want to reread the definition of net profit margin versus gross profit margin, send you a link for that. And then some budget, marketing, different things people are doing or opinions that they have that kind of co-align with what we're seeing on some of our designers' reports. So we kind of pulled those and we're like, yes, those make sense. Those are
Yeah.
exactly what we're seeing. So I tagged those in there. So we can send any of that to you. Just let us know if you have any additional questions beyond that. Thanks for showing up. Talk
Thanks.
to you later. Now where do I close it?
End at the bottom, maybe. And broadcast.